thank you everyone for coming here. And before we get started, I guess I'll just say that I realize this is the last session of the day. And I do realize that our minds can waver about the evening cocktail hour. So will mine. So I will try to get through this as soon as possible without a lot of pain. We're going to talk about enterprise risk management. We're going to talk about definition, first of all, of enterprise risk management. We're going to talk about the implementation of challenging a model or a program to measure ERM and the framework that we want to use to try to measure risk in your organization. We'll look at some functional areas. We'll look at, this is all basically the process that we'll talk about, how to do it. There's really no specific process out there. I mean, it's really what's commensurate for your particular organization. So today, we're going to first define what is enterprise risk management. What is ERM? I think that's probably the hardest aspect, is trying to deal with confusion, is how to measure risk and how to define risk. Some of the concepts that are out there that talk about measuring potential for loss of assets, measuring the potential for loss of future earnings and capital, and measuring risk for accidental losses and strategic operational risk. It's kind of heavy-handed stuff, but that's the kind of guidance that's out there. COSO, some of you may be familiar with, the organization that is out there that has expressed some guidance in respect to internal controls and risk management, has its definition of ERM. And I'll read it actually. A process effected by an entity's board of directors, management, and other personnel, applied in a strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite to provide reasonable assurance regarding the achievement of entity objectives. Wow, just a little bit for me. I don't know if, I'm sure smart people can understand that. I really can't. But that's the guidance that's out there. That's what we have to deal with. So how do we define ERM? Definition of ERM. I mean, how can you build something when you don't understand it? You don't know what it means. So we've got to first define it and say, what do we want to build? How do you apply the concept in a practical way for a financial community bank? Practical way, that's what we're going to talk about today. I think there's a lot of guidance that talks about loss of assets and this and Basel standard and COSO standards, but what is really a practical way that we can really do this? I hope we can do that today. And if we do build something, what's the sense of building it if there's no benefit to it? You don't want to just do it because the regulators are telling you to do it, or because it looks good, it's kind of cool, that's the buzzword out there, we've got to build ERM, we've got to move in that direction. Really got to have some definable benefit related to it. So what is ERM? You know, in 1964, Supreme Court Justice, having difficulty explaining pornography, simply said, you know, I can't explain it, but I know when I see it. I think ERM is like that. I'm not sure what it is, but I think if I see it, I kind of know what it is. You know, for me, I guess an ERM would be a warning system. You have, when you think about it, you've got highways and traffic, you've got roads, you've got people crossing street, you've got cars. You need a warning system to manage all of that. So it would be great if we had our own traffic light in our organization. It gave us red light, green light, orange, told us we're going the wrong direction, stop something, slow down, move away. That'd be kind of cool if we had a traffic light system. So maybe we want to try to build some sort of traffic light. If we had a red alert system, it reminds me of like Star Trek episode. I don't know how many of you watch Star Trek, and you had the Klingons approaching you, and you get this red alert, they're approaching you. And you have to put up those, defense shield up, because if you don't put it up, then you get torpedoed down. And if you put it up, then what do you do with it? Do you fight the Klingons? Do you have enough torpedoes? Do you have enough phaser fuels? Or do we get Scotty to give warp 10 and get out of there? So you got some choices. Now you got an alert system that's going to give you some choices. You can make some decision making. So that's really, you do want some benefit if you're going to build an ERM system. So I think we kind of know it. Maybe I didn't define it, but I think it kind of picturized what we want in terms of an ERM system. It's some sort of warning system we want to build. How do you build it? Okay. We're going to talk about today is a two-pronged approach to ERM. Every organization, even yours, has a lot of controls and processes. And they're there for a certain reason. Because you're trying to either get something done or manage your risks. So we want to do is first prong is a method to validate the various processes and controls that you have in place are working. Is everyone doing what they're supposed to be doing? And if they're not doing, probably it's going to elevate your risk if they're not doing what they're supposed to be doing. So it'd be nice if we could somehow take a listing of all the processes and controls that we think are important, find out who's supposed to be doing it, and then if they're not doing it, we could say, aha, we've got a problem here. So first prong in our ERM traffic light would be, is we need a methodology to measure those controls and processes. The second one is, even if they are doing what they're supposed to be doing, what if we're making the wrong decisions? What if we're giving out the wrong kind of loans? So we need a quantitative way to ensure that a business strategy in place is generating the right results. Is our strategy adequate? Are we making the right business decisions? If we can merge the two, maybe we could get our traffic light. So one prong, controls and processes. Second, measurement of our business decisions. That's what we want to try to accomplish today. So how do we do it? I don't know. Let's see. Hurdles for implementation. Every good thing has hurdles in it, obviously. There is no clear regulatory guidance. We talked about COSO. I didn't understand it. Basel standard. COSO and Basel standards define measurement and quantification risk. They're really geared for large institutions. Some of them not even banks. They really cut across industry lines. And I think banking is kind of unique and needs risk standards of its own because of its uniqueness. So I'm not sure the COSO and Basel standard really speak to banking. And especially even if they do speak to banking, not to community banking. Then the other, and probably the most important thing, is the data that you need. Centralizing the data needed to measure and identifying the risk is difficult. And that's probably the hardest aspect, is getting all the data that we need to define the risk. So these are some of our hurdles in implementing our system. Whatever we do, you need an enterprise-wide approach, a holistic approach, and when you do build it, it's got to be meaningful. It has to be understood and useful at the board of directors level, because if they don't understand it, nobody's going to use it. So framework for implementation, define your risk, measure it, and then manage it. Once we can measure, we want to be able to use what we build to manage it. Otherwise, there's no sense in building it. All right, so I think we're ready to start now. Before we can start, what you want to do is make an inventory of things. We talked about it has to be enterprise-wide. So first, we want to do is, who's going to participate in this? This is just an example of some of the functional areas that you may want to consider in your organization. A typical community bank would have the lending area, financial reporting, regulatory compliance, branch administration. So you're making a listing of all your areas first. Who's going to participate in this? Then ERM, risk. What we need to do is define the risk categories. There's a lot of, the OCC, for example, and other regulators have defined some risk categories. So we have a listing of categories of risks that we think are important for our organization. So we make a list of some of these risk categories. In this case, we've identified financial reporting, operational, credit, information systems, reputation risk, etc. So these are just some of the risk categories that we're going to be using and try to in our model. So we've got the functional areas, and we've got the risk categories. Now what we have to do is identify the controls and processes we talked about in each of those functional areas that we think are important, and assign what we call the inherent risk, a benchmark, a starting point. So what we're going to do is do a bottom-up approach. Any risk management, a good model, really got to start from the bottom up. Take an inventory of all your key controls by all those functional areas. Sit down with the department heads in each one of those functional areas. Sit them down in a room with their key people. What's some of the key controls and processes that they think are relevant managing the risks of their areas? Most of them have a pretty good idea about it. Then you tag those controls and processes